All right, Colin's asking, our spectrum of opportunity law. I understand this in terms of number of times price is likely to traverse. Sorry, I'm stuttering. It's Friday. Number of times price is likely to traverse a CVA, but does it also apply in terms of how far price may range from the open? For example, today I didn't take the last trade opportunity of the day, a breakout pullback below the July 30th composite value low. Nice nomenclature, Colin. Because I felt like the session had run far and sellers were running out of steam. Is that a correct way to think, or should I be thinking more along the lines of anything can happen and price can range far as far as it likes? So several questions in one here. The short answer is yes, spectrum of opportunity will include what type of ranges we could anticipate or expect or think is most feasible or probable. That would be a yes. If you've got, how did we kind of teach it in the course? It was around, well, look, if you've got this fresh shift in condition and open space, and confluence and those things, well, not only does it mean that that opportunity is generally better and it might move cleaner and be easier to trade. It typically means that there's more room for that market to run. Not always, but most of the time, I think that's true. And especially when you do get into situations where you break away from balance. Those are times where we certainly know we could run further than we have been within, balance and whatnot. Now, when it comes to late day opportunities, quite frankly, a lot of the trades that you and others were taking, today, I think they were good practice for y'all. I think it's all good stuff. Looking, okay, let's look at this, composite from July, and let's take every single trade every time we interact with it. And I'll just draw some stuff for you here real quick. We've got this composite from July, okay? And then we've spent several months, okay? And then we come down and interact with it. And then not only did we do this and that was a trade, but then later on we did this and that was a trade, and then we did this, and then this was a trade, and then that fails and this was a trade. And I understand it's kind of difficult to explain, but today there's a whole lot more volatility than is normal. So you're seeing 10 opportunities when you would normally see one structural breakout pullback or return pullback. So understand that that's very, very different than is normal. Also understand that almost none of these opportunities are A plus, are they? Because of the recency. This is really, really old. And now I know you guys were doing great work in the room today. And that's the references and the trades you should be looking at based on our learning and what we're doing here. But we'll learn more things that will be a little more relevant. There's that Friday kicking in again. Relevant to current conditions, especially when you get this big lift in volatility that tends to do what? That tends to leave the more recent areas of structure. So you guys are a little handcuffed with what you can do and see right now from like an A+++ perspective, but you're doing great work. You're seeing the right things. So really wrapping up this question, during normal conditions, you definitely want to think along the lines of spectrum of opportunity and kind of be done for the day. When you reach a major destination and RVOL's not elevated and things aren't crazy and the VIX isn't spiking and that type of situation, just be done, because there's the reason why that law exists, the spectrum of opportunity law, is because I want you guys to walk away. I want you guys to not take 8 more trades thinking, Well, here's another little micro return pullback of the same area that we've crisscrossed 5 times today. Those aren't opportunities anymore. So I like you thinking, this is really kind of played out here. That's the reason for that law for the most part. What's difficult about today is context and the spiking of volatility. And today's the kind of day where you should keep trading. Yesterday was the kind of day where you should keep trading. You should be beat, tired, taking naps after the trading session because you've been so focused in trading during these conditions as a day trader, right? Good question. Tony, hey, a question regarding execution. At the moment, we're using turning points in Heikinashi. However, sometimes when a bar closes, the risk reward would have changed drastically. Would you say using order flow to support execution will solve this problem significantly? I don't think order flow is going to solve that problem, although it can help, right? We will get into looking at footprint charts and different things. And ultimately, as a more advanced trader, you will maybe at times, maybe all the time, maybe never move away from trading Heikinashi turning points. Trust me, guys, they're great. I'm a freaking decade plus veteran pro trader here, and I'm telling you, they're great. There's nothing magic about them or anything. You try and slap on a real tight moving average and look for that to break. If you try and draw little trend lines and look for that to break, if you look for where RSI, gets elevated and begins to turn, or the same thing with the MACD, Heikinashi does essentially what those things do, and it does a good job. So it's training wheels in the sense of opening y'all's eyes to see some of this stuff and to look for a quality pullback and things like that. But anyways, I'm going down a tangent here. Let me answer the question a little more directly. Order flow will help in a small extent, but in general, when we start to see enough of a price momentum shift as we get more advanced, and hopefully order flow supports that, we're going to pull the trigger before it gets too far away from us. Or there are times where you're stalking a short entry and it just does this, and you just, you miss it. All of a sudden the risk reward is too far, and you need to maybe either wait for a second chance entry if you get it, or it just goes and you don't get it. That's always going to be a component of trading for most any methodologies. Good question, though. Alex asks, number one, are daily hypos always LMDs? If not, can you give a few examples of non-LMD hypos? No, they're not always LMDs, and no, I'm not going to give you any examples because that's not where we're at in the course. So today is a Q&A for where we're at. Number two, are the levels in your DMI only derived from CVAs and PVAs? Again, no, they are also derived from other things, which we will get to in good time. Sean says, when you say once you achieve your destination across a CVA, there's less opportunity. Do you stop trading, or do you just keep your profit targets shorter, tighter stops, or just be more cautious? Like look for a faux trade. A faux trade's not a trade. A faux trade's a trade to avoid, by the way. We'll clear that up. So let's talk about it. It's gonna be complex to answer this. I could answer it from a simple point of view, which is where we're kind of understanding at the moment, and I will start by doing that, but then I'm going to let you know kind of where we'll go in the future with that. So, if we take this return pullback short and ultimately it reaches the destination, I think right now that's a place to get out of the trade. That is your law of market dynamic completing, therefore spectrum of opportunity dwindling. So the trade's done, get out, take your profits. As we get more advanced, as we add more complexities to our read on narrative, we may have other things on our radar that say we could go even further. And at this point, right here, you're going to have a choice. You're always going to have the choice of, you know what? We reached the edge of that balance area. And depending on the priority of the CVA, right? Is it recent? Does it have decent duration? What do we think about that relative to some of the other narrative stuff, that Alex was asking about that we're going to get to in the future? It might all be that you take the exit. And then if there's more on the table, if there's more downside from other references and other analysis, you can always exit here. And if you do break, hopefully you get this and you just get back in. Is there a risk of getting out and then it just going to zero on you? Yes. But I'm kind of getting tired of answering that, quite frankly. And it's no offense to you guys. It's just I've been answering that question for so many years now. Trade management will never, ever, ever, no matter how much you learn about NADRO, no matter how much gets revealed to you about speaking the language of the markets, sometimes you're going to get out, it's going to keep going. Sometimes you're going to not get out and it's going to turn around and stop you out. There is no such thing as perfection when it comes to trade management, but we will use best practices and we will try to do what we feel is best given the situation and the overall context. And we're going to get more complex with that as we go. Nick asks, do you still consider a poor high or low interesting if it was cleaned up overnight? The answer is yes. The answer is it's slightly less interesting, but it is still interesting. Patrick asks, during the March-April madness in markets, did your definition or criteria for balance change? Trend days almost every day. How did you handle the lack of reference points from CVAs in a normal market? I'd love to see your charts for that period. I found myself straining to create CVAs. Well, let's go see what I have. I can tell you one thing on the drawing board real quick is that I do recall there being some, imagine that like the past day had looked like this, and then this day looked like this, and then this day looked like this, and then you get this, right? And then you get this, and you get something that's off the chart here and does that or whatever. I remember putting together a huge range, but it was still a CVA. So I remember doing that. Another thing is, again, just like I mentioned earlier, when volatility goes through the roof, we will have some other tools to lean on which stay more relevant. They are more dynamic. They adjust with volatility, and we're gonna introduce those as we go on. But the short answer is that the CVAs still work. You may have had a 3-day CVA down here. And that level, just like I talked about on the nightly report last night, needs to be thought of as essentially one line because the volatility is so blown out compared to this 3 days of range. You're going to need to just trade it as if it was an area. And who cares if it goes into it or slightly even goes below it if you're trading to get long from the upper edge of it. That's a tremendous shift in volatility. That's kind of an extreme example. But I've changed chart books. I redo my chart books. You guys have probably noticed I change the colors of my chart books all the time. But let's pull some stuff up. So here we're looking at crude oil. Let's go back, see what we got. So as you can see, the ranges are absolutely ginormous. Looks like we put in a balance here, right? And the drawing got deleted somehow. Looks like we put in a balance here. This was obviously one that I hung on to and persisted for quite a while. This looks like a couple day balance here. So, you know, while, as you can see, I'm just going to, oh yeah, we went even down here. Not sure what happened here. We might could, you know, merge these and start to look at a 2-day there or something like that. But as you can see, the volatility is huge. We're ranging from, you know, 38 to 28, which was awesome. But you're right, there wasn't a whole lot of balance, but there was a few spots. This would be another area here where maybe there's a 3-day little balance, maybe a 2-day. I'd have to go in and double check it, but there was balance from time to time, and we'll use them where we can. Rafi asks, Rafi, I'm not sure which one. You can let me know a pronunciation spelling in the chat if you want. We have a guy named, so it is Rafi, yeah. So, okay, cool. If we open inside a CVA, then later accept into a CVA above this one, are we imbalanced up or rotational? That's a great question. I really like that. The answer is we're imbalanced up. The current condition, as kind of what you're asking, what's the current condition? Is it imbalanced or rotational? And that's always a multifaceted thing. We can have different current conditions on different time frames. Right now, we essentially have one time frame. As we get more complex, we're going to have more than one time frame, so get ready for that. But right now, we have one, so it's pretty simple, and you want to lean on the most recent. So let's say that, you know, this balance was here, right? And well, as it would have been, and this day leaves, right, as it did, and breaks from here, and maybe we got a breakout pullback or something, and then we went down. And let's pretend, actually, let's kind of redo it. Let's pretend that this balance was, you know, higher, and we actually did go inside this area. The answer is we're still imbalanced down because today is a day one break from the most recent CBA. So that's how you want to think of that. From there, I'll go ahead and tell you, it gets grayer and grayer and grayer. But you do want to kind of consider the most recent key shift in condition and kind of hang on to that as the current condition until proven otherwise, right? You might start to see multiple days of balance coming in, right? So now you have a fresh 2-day balance, which we know is balancing within this older balance. And you could say the current condition is pretty balanced. But at the same time, let's think about it. We have recently broken down from a 3-day balance, and now we're just balancing 2 days. So in a sense, the value migration of composite value is still lower. So in a sense, we're still in balance down. But so I'm sorry to muddy the waters there. I'm sorry to give you a almost confusing answer. But the thing you want to focus on right now is that simple first answer that I gave you. But as we'll begin to learn more and more about these things, there's a lot of different ways to view it. Ultimately, the answer to great trading is not going to come down to you every single day saying current market condition is balanced. Therefore, this is what I'm absolutely going to do. As I mentioned, if we had the day one break from this balance area, and then we put in a 2-day CVA here, and we're opening in here, sure, I'm going to be to also agree with you, and we'll say the current condition is balanced. But now answer me this in the chat, Rafi. Do you prefer from this point forward, which trade are you more interested in? Trade 1 or trade 2? Trade 2 for sure. That's because you guys understand the complexity of what I just described. And that is current condition is balanced. But if we break to the upside from our immediate, composite number 2, let's call it, because it happened second, even though it's most recent, we know that we're just headed back to composite 1 kind of, and maybe we even ping pong in this area because there's overall balance in that market. But if we break downside for trade 2, that's a continuation of this break and now another break. And so I think there's more opportunity there. So it's complex, but hopefully that helps you. Great. Patrick, that's a confusing question. Condition shifts, what are they? You should know that. Not to be a jerk, but if you're asking that question, I would definitely go back and watch the video of that teaching session a few more times. So a condition shift is where we go from one condition to the other. That's either from balance to imbalance or from imbalance back to balance. Your second question, how many are there? Well, I guess there's 2 then. I at first I didn't even understand that question, but yeah, there's only one definition. There's only one thing that's a condition shift, but it can happen in essentially 2 different ways. Is this statement true? Quote, every A+ trade is preceded with a condition shift. End quote. And what is the trigger criteria for a condition shift confirmation? I like where you're headed with this, and that's where we're headed with this next week, actually. You're starting to say, I get it theoretically, but let's get really specific here, and let's talk about at what point, really the way to ask it is, at what point does the condition shift, right? And that's something we're going to get to next week, and well, in fact, in 3 days, right? After the weekend, we're gonna talk about that, and we're gonna use intraday charts. We're gonna look at how far we move away from the point of shift. We're gonna look at how much time we spend beyond the point of shift. We're gonna combine a lot of things to look at what I define as the term acceptance. And so we're going to get there. And I like that you're one step ahead of me here. Cool. When setting up TPOs for currencies, is it best to use pit session times or a 24-hour TPO? Yeah, Justin, that's a tricky one. In general, 24-hour is probably best. One thing you may consider doing with something like gold, something like the euro or the yen, you might even consider, dare I say, using volume profile instead of market profile. You guys know, I mean, all we've talked about this week is market profile. I'm a huge market profile fan. It works amazingly. It does things for me and for us that volume profile doesn't do. Volume profile is not going to show us a nice 3 wide pour high, right? Because we don't have a concept of time. Why do I suggest that? is because the one downside of market profile, and the reason why I use pit sessions wherever appropriate, and by appropriate, I mean that it fits the pattern of increased volume for a period of time, and then the volume dries up under normal circumstances. So if this is our 24-hour period, and this is 9 a.m. to 2:30 p.m. in crude oil, well, you know, the volume does this, right? And then it's you know, it's a lot lower. You know, maybe it ramps up a little bit coming into the open, and it's pretty dead, you know, through here. That's what it looks like. So market profile from this period to this period is really all I care about. And if you use a 24-hour profile, let's take this and pretend that this was a session, and now let's give it a range, okay? And in fact, I'll draw out what happened. Overnight is here, and then the day session is here. Okay? This profile, my friends, oh crap, this is not a great example. Anyway, maybe it'll work. This profile is going to look like this. And you're going to look at this profile, and you're going to see two equal distributions. And I'm not worried about where value is at or anything. Just focus on the balance areas with me. Those are not equal because balance 1 occurred during this period of time, and this period of time maybe, right? Let's say it started here and then it goes to the next day and starts through here, right? Oops. And balance 2 occurred on tremendously more volume and participation and inventory being created and modified, and which is what auction market's all about. It's the only one that matters in this case. However, if you have so that's why I don't use overnight market profile, is because if price is sitting there marking time and nobody's really trading it, that's not really a distribution that I care about, is it? So I like the features, the single prints, the poor highs, excess, lack of excess, all that stuff, and the oversimplification, not in a negative way, but the further simplification that market profile gives me. But if it's going to come down to messing with distributions, which are very unequal in terms of how they should be viewed in terms of importance, I might even suggest you do a volume profile. And what's that volume profile going to look like? It's going to look like this. You can't have a daily volume profile chart and just merge them like one at a time, like or whatnot. You could add volume profile to a market profile chart and merge it and only use the volume profile, or you could do custom drawn volume profiles within Sierra on a price action chart to come up with where you're defining the balance. But it's kind of chicken or the egg there, because how are you defining that without really seeing the value and where it is if you're just looking at a price chart? So it could be tough, but price with daily profiles, daily volume profiles on it, plus custom composites is probably the way to go there. So anyways, is using a 24-hour market profile going to absolutely screw you over? No, it's not. It's probably viable. Another thing you can do is, you know, maybe some type of hybrid session. Look for the euro. What does the volume typically look like under a lot of days and like normal conditions? Maybe it starts up at the European Open and then it kind of dies off towards the European close. Maybe use that. Maybe it still keeps going pretty good through the rest of the CME close in the States. Maybe use European Open to US close, right? Find where that volume is, and if you make a market profile out of that, it's going to be really good. But I almost want to apologize for being so complex there. Try out 24-hour profiles. That, you know, it's not going to kill you. Anonymous attendee asking about long-term VWAPs. I'm probably not going to answer that. Do you give any weight to TPO value area? I don't use any TPO value areas on longer term charts. So guys, yeah, we use long-term VWAPs. We're going to get to that. We're not there yet. Not going to answer it. S&P Composite, Rosie, S&P Composite, August 10th through the 21st-ish. Is that a good composite? Or did I include a couple days that were migrating higher and shouldn't have? Looks like you did something a little different than me. I went starting on the 11th up until the 17th, started its own couple day there. And as you can see, there's some value overlap, so I know what you're seeing there. And let's go to an individual and just take a look at it. So the 11th, and I've got my TPO size really adjusted here. Why is that, right? Take a look. I usually use 3 ticks, and I've got it a little scrunched up. And I've got this where I can see a full day's range at least set to 8 ticks. Let's just set it back to 3 real quick as we go back to this sequence. So, you know, to me, I can even see it with my eyes here. It's a group here and a group here, right? And if you, even if you make this CVA, this day begins essentially a clear breakout pullback that holds, Rosie. So from that point, you know, sure, we ended up with some dip back into here, but overall, this is a new area of balance that begins to form. And after 3 whole days of quality breakout pullback, with only excess being back into that area. So at the end of the day, it is, well, it's not that we go back into the balance. I mean, even if we formed this 3-day up here, which is pretty obvious, okay, and then broke back into here, the original CVA, and then just continued to balance, I'm just going to start, I'm going to end up with a third one, right? I'm going to have this, and then I'm going to start building this one out. And then if it's like a really long time of balancing within, let's say, this general bracketed area, I will then, as like a step 3, consider, do I want to put all this together and see if it's just a big merge? And let's also just see what yours looks like, you know. Look at that. It's you see price being representative. It's got a little extra up here, more than we like, but it's a decent balance. That's not it's not wrong to merge. I definitely wouldn't include the 21st. The 21st was a day that opened, broke, retested, and never came back, and it led to the whole up move, right? The 21st is a mistake to merge with any of that, of the big balance. All right. Scenario. We're in balance. We're rotational inside balance. Price often traverses only 2/3 of the way across the value area. Not sure I agree with that. If trading one lot, is it better to set the target at the point of control? No. You know, you may understand this stuff better than I do, right? You may have this, you know, understanding that we only go 2/3 of the way across. It sounds like you should set your target at 2/3 of the way across. But for me and what I teach, we have a law of market dynamic that says the market tends to attempt to traverse and test the far opposite edge. So for me, no, I don't, you know, set targets to just come out at the point of control. I tend to mostly ignore points of control. Shocker. A lot of people find that very confusing, that don't understand, that haven't, you know, been taught by me like you guys have. What did I tell Anthony Credelli? Asked me in one sentence or something. What is your edge or whatever? Does anybody know what my answer was? Exactly. You guys listen to it. My edge comes from the edges, So and look, Colin, I'm scaling out, man. I'm not, and I know your question says if I'm trading a one lot, should I just, and the ultimate answer is for people trading a one lot, I'm not going to recommend you go for huge targets. I'm going to recommend you go for smaller targets, which are not even going to be based on the full narrative destination. It's purely going to be based on our shorter term charts. But your bias and the trades you're even looking to get into on that short term chart are going to be based on the narrative, right? So, someone who's just trading one lot, I'm going to have you coming out probably before the point of control and just building up some profits. And let's get you to the point where you can trade two. And then let's continue taking that scale out. And then we can let the second one as a runner, right, go for that destination. And look, if it turns around at the 3/4 of the way there, we're also going to equip you with ways of identifying intraday where things start to change, where there's a shift on the tape, that you're not going to sit there blindfolded and always give back 100% of profits. Now, let me also be really clear that I think there are times and situations that call for you to be willing and ready and more than happy to give back a lot of open P&L if it turns around and if it comes and gets you. You're never going to catch big moves if you're not willing to do that. If you're always managing a trade that begins to pull back against you and the order flow doesn't look perfect or whatever it is, you're always going to overmanage trades. You're always going to come out of stuff early, and you're never going to catch those big R multiples. You can't have your cake and eat it too in that regard. We can, in a sense, and that's breaking up into multiple positions with different job descriptions. We have a short-term system we're going to use, take quicker profits, and then we're going to have a longer-term system, which is more narrative completion based. And by the way, if you're doing something like trading one ES contract, do yourself a favor and trade multiple micros. Nathaniel, trading pullbacks is new for me. I used to try and front run breakouts. Once the pullback starts, I worry, am I going to get steamrolled if I get in too soon, or the energy is gone now, etc.? Can you expand on trading pullbacks some for the recovering breakout trader mindset? Maybe a dumb question, just want to hear you speak about it. It's not a dumb question at all. And in fact, you might ultimately, I think it's good for you in this program to like come under my wing and experience my world for a bit, right? That's going to broaden your horizons and maybe make you more than a one-trick pony in terms of breakout entries, right? But maybe a year from now, you have both tricks up your sleeve. Maybe you develop a playbook that allows you to, under certain situations, narrative, volatility conditions, whatever it might be, you take breakouts and they work. And you've studied that. And during other conditions, you only take pullbacks. During certain, playbook ABC trade versus playbook DEF trade, right? So, you're being a student, you're being a good student right now, and I think have a larger perspective around where it is you may ultimately end up, and that's important to keep in mind. But you're right. If you're going to wait for a pullback and you would have already been in and experiencing some of this beautiful momentum from a breakout entry, let's for those of you less advanced, let's draw it out. So he's saying, I'm short right here. And you're telling me, don't get short yet. Don't capture any of those profits. And in fact, wait and hope that it just doesn't do this. And it's got to come back. And there we find our trade. And hopefully that one is the one that goes too, right? And the unavoidable truth is, if you're going to be a pullback trader like me, situation A here is going to happen sometimes, and you don't get a trade. So maybe you, like I said, with your breakout trading experience, which I never had, by the way, I kind of, once I halfway knew what I was doing, I was just kind of trained on pullback trading. The thing I like about pullback trading is the tighter risk, right? So unless you're going to say momentum has to immediately persist, right, and able to put your stop here, your stop probably for a breakout trader has to be back somewhere inside the area of the breakout. Maybe you find some swing high up there, something like that. I don't know, right? There's a million ways to go about things, but in general, that's I've never heard a pro that didn't have that type of thought process there. Well, guess what? If the momentum's not really clean, you're getting wicked out of that trade all the time, even if it does go to zero. And if your stop's way up here, well, guess what? Your risk reward is, a fraction of what mine's going to be. Right? Less than half sometimes. So I like pullback trading because it gives me really nice risk reward. I can get bigger in trades because my stops are tighter. But there's always the threat that it goes without you. So maybe, like I said, you combine experiences once this is all said and done, and you can do a bit of both. Steve, do you ever consider a change of condition valid that has occurred recently but prior to the open? Absolutely. I don't care when it happens. You could take a trade at 4 o'clock in the morning, guys, and it's just as good as a trade at 9 o'clock in the morning, and it's just as good as a trade at noon. If you've got a fresh condition shift and you've got the things that you will ultimately figure out as we complete this program that you need to have an A+ trade for you, it doesn't matter what the time is. It doesn't matter. Paul, looking at crude today as it relates to value, around the low, around noon, would that be a quality long, or would we consider passing on that trade given we'd still had a bearish bias, seeing as we'd not tested the value area high at that point? All right, so let's go back to crude. In fact, we'll pull up our live Nadro chart book, because I'm only going to answer anything in regard to what we're using. So crude around 11:30, I think is what he said, around noon. Would it be a quality long, or would we consider passing on that given we had a bearish bias and had not tested? Right. Okay. So he's saying we never got the retest up here yet. So are we interested in getting long here at noon? Well, I think there is a couple problems with that. One of which, you pointed out. I'll give you that. We hadn't yet gotten the full. I think actually we hadn't yet gotten the value area high yet is actually kind of in favor of the bull, even though it's a minor point. We hadn't gotten that yet. The thing that I don't like about this particular situation, well, let's take it from the basics first. The thing that's not great is that we haven't put any really good excess at this low. And one of the things the market is telling us is that we haven't been able to retest this area. And we did have, why didn't we retest that area? Let's draw a level from that poor low that I pointed out in yesterday's report and see where that is on this chart. Oh, it's this. I think we talked about that. So the market, there was a lot of inventory there, people who had defended that level, and we got a really nice bounce yesterday. Well, guess what? They're stopping out, and then if they didn't stop out, they're feeling pain below there, and they're stopping out at break even on retests. So that's why we weren't getting up there. What other mysteries can we solve? I know it looks like E period gave some excess, but honestly, it's not great. Anyways, it's the third time back down into the same prior composite value area low. So I know that if we look at this, it would have looked like, you know, this with E period giving us 2 ticks of excess compared to D period and even F period as it started to break down. But when you just keep knocking on the door, eventually you're going to get let in. I mean, that's really how I see this. Not to mention what's not happening, the real kind, right? We can't accept back into yesterday's range. And that 3 wide poor low is the culprit. So I don't love the long here, short answer, because we do keep pressing on this. Remember the auction market theory example where if you're going to get a car, there's a lot of buyers and sellers when we come down to this low and it drifts up and it comes back down here and there's a lot of buyers and sellers and it goes back up, even if it wicks this high like ours did here. And you come down here again, I don't see this, even if this low was a little bit lower like it was, right? I don't see that as a great place. And look, there's no fresh condition change, right? Everything's bearish, right? We started out above here. We broke in. That's a bearish condition change. There's a bearish condition change. There's a bearish condition change. And now we want to get long, maybe the third retest of the lower edge after all this bearishness. Poor high reference holding us down? I don't think so. David, Merritt, I was prepping for crude and noticed that my hypos for the day was coming from 2 older CVAs. I know the hypos for these CVAs are not considered A+ because they're not the most recent. Do you make any adjustments as far as laws of market dynamics expectations are concerned? Also, what if the older balance was a 10-day balance? Great question, DP. All right. The first answer is yes. Well, we don't adjust our LMDs, but the quality of the narrative read should be lower because the references are older. A lot of times, like what we saw in crude or like what we've seen in the S&P recently, what I'm doing, and this isn't necessarily more advanced than you guys. You could still do this too, although I liked the way most of you approached it by looking for more opportunities and getting reps in. If we've got a big break and then we've got however many other CVA levels or whatever down here, I almost see it like I just drew it. A breakdown, which is bearish, right? And then some other inflections to look at. And I'm probably not going to buy a first test of any of them. What I'll probably need to see to get long at all is for us to fully attempt to break one down and then really show me that that just failed. And then if I get a really weak retest into that area, I might look for that trade. But in general, what am I looking for? We're bearish contextually. I'm looking for a hold underneath that to short, a hold underneath that to short, a hold underneath that to short. That's really what I'm looking for. So I'm using for my narrative and my main bias. Remember how one of those first questions, we could say that we are rotational in a fresh 2-day balance, but that was after we'd broken down from, let's say, a 2 or 3 day balance. So we're like rotational / more bearish. So if I did take one of these longs like I drew here, I'm looking for nothing more than a scalp, unless just something crazy happens and it surprises me and I get lucky. I'm really looking for places to get bearish because the most recent shift in condition that really matters, it has me bearish. Now, that doesn't mean I'm not going to use intraday tools and order flow and whatnot, and I might get long 20 times that day. But in the back of my mind, I'm still going to know that I'm overall bearish. But that doesn't prevent me from getting long sometimes as a more advanced trader. So if you guys wanted to, if our goal this week would have been to like really get A+, I wouldn't have wanted to see any of those return pullbacks long in some of the markets that we saw. You really want to hit the shorts based on the value migration lower and the break from recent balance and all that kind of stuff. Let's see. Was there another part of the question? So it doesn't affect our LMDs, but it does affect the strength of the narrative and what we see as a good trade versus maybe what I call a little scalp play or something. And then the second part of your question I really love. What if the older day balance was a 10-day balance? That's a really great question. 2-day balance following a 10-day balance. In this case, I'm gonna give a lot more weight to this big juggernaut here if we do break down and if I do get this opportunity. Because in this case, and here's a great question for today and whatnot. Merritt, how do you handle when recency is conflicting duration? Because that's essentially what we have here. The most, composite A is recent, but composite B has more duration. And furthermore, if you want to get really tricky, let's do another scenario. I'm just going to draw over this stuff. Don't worry about it. Let's pretend that it's more like this. A is a 2-day balance and B is a 3-day balance. Now what are we going to do? Which is more important, the recent 2-day balance or the more duration but older 3-day balance? In that case, yeah, I mean, like, I don't have answers to all this stuff, guys. I just don't. Off the top of my head here, I'm probably going to go with the more recent 2-day break over here. And for sure over here, I'm going to go with the duration. But I just wanted to give you a tough example of there's going to be times where recency and duration, it's like, oof, kind of a toss-up between balancing the importance of those that disagree with each other. So yeah, maybe it's tough, Jao, to fully answer like that it doesn't affect our laws of market dynamics, because look, what laws of market dynamics are mostly designed around are your primary, most recent structures, or in the case of duration, most important structures because it has such duration. Laws of market dynamics also apply to older structures, like you guys were trading in the S&P today or crude today, but they carry less weight because a lot of where we're building our bias from, our overall narrative from, still has something to do with what's most important with the recent breaks and things like that. All right, hope everybody's doing okay. We're covering some tough topics that we don't necessarily have picture perfect crystal clarity around at all times. And you're going to have to be okay with that. You're going to have to make some decisions at times as to how you weight. You know, in week 6 of this program, you know what we're going to be talking a lot about? Ranking and distilling information. And we're starting to get into that right here today. Ranking and distilling down information is going to be one of the most critical things you learn to do. Because guess what, guys? The examples we're going through right here are as simple as it gets. And we're already starting to deal with some ambiguity from time to time. So things are complex, right? I really, Nadro is really, really good at giving you, despite there being potential at times for dissonance and a lack of clarity or not sure what the right decision might be. Again, a more advanced topic is around how do we handle dissonance? That's something that is just going to take some time. It's not something I could teach you in a Q&A session. I will give you best practices. I will tell you where sometimes it's a toss-up. And guess what? When it's a toss-up on your CVA chart like we're dealing with here, the good news is that we're going to have several other charts which can be tiebreakers. And so that's going to be a beautiful thing. When you're unsure about this structure or that structure, you might have some real clarity on a different chart on a different time frame that says, oh no, you should definitely be bearish. So we're just going to look for, breakout pullbacks to the downside or return pullbacks to the downside of either of these CVAs that we're kind of unsure of which one's more important. It won't matter at all which of those are more important. But you're going to have to learn to rank and distill information to get to that point, to make those type decisions. But it will clear up some uncertainty on a single time frame you might deal with. And guys, please change your name from anonymous. Please don't be anonymous. You guys are my students. I get to know you over time, and don't come into these meetings and be anonymous. But I'll answer it this time. Do points of control of CVAs matter or just the edges? They matter, but they should be something where they surprise you when they give us that strong reaction, which is one of our laws. You're only anonymous if you would have literally had to type in your name as anonymous. So you can check it in the Q&A. I didn't even know that. Learn something new. So don't do that. Let me draw to help out here. CVA, point of control. To me, I don't even see the point of control, essentially, until the point of control grabs me by the shirt collar and says, listen to me, look at me, pay attention to me, right? So my general theoretical, this is not the way price is going to move unless volatility expands hugely like we've seen. This is what I'm looking for. So this is a non-factor. But if that's in progress and then all of a sudden it does this, Well, now I'm going to pay attention to that. And depending on some shorter term tools of what this looks like, order flow wise and things like that, I'm going to judge if this is our law that says the point of control can disrupt our traversal of a balance area, or if it's just more of a normal. Sometimes you really do see a pretty normal bounce from a point of control, and then it goes further and maybe it goes back, like all that kind of stuff. So there's going to be ebbs and flows in here. So don't let ultimately for that law of disruption of traversal, you have to judge the strength of that counter trend upward rotation in this case to say, was that really significant, or is that just another normal ebb and flow as we make our way across there? Rafi, in terms of Law 10 compression, is that specific wedging shape an absolute requirement for it to be valid, or can we be slightly looser with the way price action is moving into the level? For Law 10 compression, I'm pretty specific. As I was giving Rosie a hard time in the chat earlier today, I'm pretty picky about my Law 10s. I think it needs to have components of, number one, being compressing into not just anywhere in open space, and not just over the past 6 minutes on like a tiny time frame, right? Imagine this is like our intraday chart, and all of a sudden you see like this. Don't at me and say, Merritt, there's compression in this market, right? Like, no. That's not significant even in terms of intraday price action. What I'm going to need to see is significant intraday price action. That's number one, into the edge. It could be from inside, it can be from outside, it doesn't matter. I could draw it either way, but significant intraday price action that gets to an area, can't reach low, I should have made that 1 because I'm going to say 1. Low 2 can't reach, and it's a very nice looking, at least 3 type swings, essentially 3 counter rotations, right? The first one didn't have to touch up here yet, but from the point of the first low, it has to touch up here. From the point of the second low, which has to be higher, it has to touch up here. And the third one also has to be higher. By the time we're getting the third one, you're thinking about an actual only time that I ever do it, a breakout style entry. Maybe Nathaniel can give us all some lessons on breakout trading. So yeah, I'm looking for something pretty specific, but recall the example earlier around this type of movement into a low. This is similar to compression, but it's not compression. It's just multiple attempts signaling a general lack of excess into an area. So there's kind of that it's probably going to crack feel to it, or probabilities beginning to be skewed, similar to what a compression gives us. Really, a compression is just a very specific price action pattern around a lack of excess into a specific edge of a balance area. Patrick, you must be smarter than I am. Got the good questions coming today. I love it. All right, last question. Maybe not appropriate right now, but what market regime or condition does NADRO excel in? When does it perform poorly? Guys, these are the type of questions that people who've been around the block ask, right? No offense to those of you who are like, Merritt, I trust you. Let's get into it. Let's go. But this is advanced. I like these advanced questions here, questioning things. This is good. I like independent thinkers. It's tough for any trader to profit when markets get so low volatility that the even the intraday rotations, if you will, even if we go nowhere on the day and this whole range is 10 points, right? Today in the S&P, like one rotation is like 10 points, right? It's doing like that. So even if the whole day is 10 points of range, we could still have good conditions for trading NADRO. The question comes down to the shorter term. If there's too much bar-to-bar overlap, I find it tremendously difficult to profit, right? So if we were to draw this instead of a line chart, we start drawing it as a bar chart. So this first up rotation and down rotation, if it looks like this, you know, on whatever time frame we look at it at, I can crush that. I can absolutely crush that if it's a trade, if context gives us the, you know, whatever, right? But if we have a day that's a 10-point range and that rotation looks more like this, you know, like I'm going to have a lot of stop outs and I'm going to re-enter and I'm going to get stopped out again and it's going to be tough. So bar to bar overlap, very like whippy, you know, not like sequential movement, no momentum to the shortest time frame. That personally gets me into trouble. I think most of my students. But in terms of even more, the past couple days, I think is where it really excels. I mean, what you're learning from me works during when the night Trump was getting elected. Well, absolutely, Sid. Sid just said, then we just switch markets. You're absolutely right. The older I get, the more I learn how valuable that is. I used to just be like, yep, I'm a crude oil guy. That's all I do. So yeah. But now back to my thing here, Patrick. NADRO and what you're going to learn intraday and all this stuff. And I remember watching, I was trading from my bed at home in New York City the night Trump was, you know, like getting elected. You know, we hadn't gone limit down yet, but we start to go down and it is fast and furious. It make, you know, way more than today was. The CVAs were respected. The intraday tools were providing great trade locations. It just worked and it worked really well. And yesterday and today, I mean, and you know, April for me was a big month. It works really. I think that's where it excels actually, is when things pick up. It works really good during normal, let's call them, conditions. And it will work during like I said, more dull conditions, as long as you're getting some decent rotations intraday. Once the rotations turn to crap, it's just kind of hard to trade in general. I'm not the kind of trader that's just like putting limit orders at extremes and taking advantage of that type stuff. That's not really something that I've ever been trained to do. So yeah, I think that was a great question, and that's a good one to end on. So I'm seeing a lot of good stuff in the room. I'm seeing people who are making a lot of sense out of CVAs, a lot of really good questions and helping each other figure out what was the right play on this date or that date. Remember, like we said, include your X and Y axes, let people know what market it is. Be clear with our nomenclature around, if you know, a return pullback or a compression or whatever it may be, of July 14th composite value area high, right? 7/11 space, all caps, CVAH, CVAH, CVAL. Or if you just want to reference a CVA in a more general term, I bet you know the acronym for that. All right, guys, great questions. Get ready for some awesome stuff on Monday, and we'll keep rolling on. Cheers.